Counting equation and Excel, adjusting entry, unearned revenue, customer deposit. Get ready and some coffee because we're about to learn the accounting foundation, the accounting equation, using Excel. We are in Excel. If you don't have access to this workbook, that's okay because we basically built this from a blank worksheet but started in a prior presentation. So if you want to build this entire worksheet from a blank sheet, you could begin back there, or you could just construct your own worksheet as we go, or possibly just follow along with good old paper and pencil. But if you do have access to this workbook, though, 5 tabs down below. Example tab, in essence, the answer key. Month 1, first month of operations. Month 2, second month of operations. Practice tab, having pre-formatted cells, so you can practice the practice problem with less Excel formatting. The ADJ tab, the one we will be working in, is where we started with a blank worksheet, but are basically working within a template now. However, we will be adding to that template as needed as we go, practicing our Excel tools and formatting as we do so. Let's go to the example tab to get an idea of what we will be doing. Remembering we're basically building our bookkeeping system using the accounting equation as, in essence, our trial balance from which we construct our major financial statements: balance sheet, income statement, statement of equity. Thus far, we've entered the first month of data represented in the month 1 tab, closed it out, entered the second month of data, and then we created our practice worksheet for the adjusting entries. Imagine it as a separate process, even if in practice you are doing both sides of these processes, what I would call the accounting or bookkeeping versus what I'm calling the adjusting process. It's easier to think in our minds as the accounting stuff being done by the bookkeeper or accounting department, the adjusting process being done by a CPA firm, public accounting, or your tax preparer. The idea being to get the financial statements as close to possible on the correct financial reporting that we are using, whether that be an accrual basis, which is the standard, or possibly a cash basis, or possibly we just need to do it on a tax basis because we need to do the taxes at the end of the year because we have an income tax responsibility, as is in the case of the United States, for example. So what we would typically do is, even if you have a QuickBooks or a Xero, even if you have access to it, even if you're doing the adjusting process yourself, I would usually make another worksheet in Excel so it's more transparent. And that works well when we don't have too many transactions as with the adjusting process. Normally, of course, I would do it with debits and credits, but we're doing it here with the good old accounting equation. Then do our adjusting entries and reversing entries, and then think about whether or not and how to enter that data into the accounting system so as not to burden the accounting process too much, remembering that we have 2 separate goals on the bookkeeping or accounting process and on the adjusting process. And so when we do our end of the year business, we don't want to mess up the accounting department doing their business. All right, so now we're on an adjusting entry for unearned revenue. So this is the one that is going to cause a lot of people kind of confusion for multiple different reasons. One reason is that many industries don't have unearned revenue because most industries are going to be collecting revenue at the same point in time as they do the work, such as in a cash register situation, or possibly they're going to be doing the work first and invoicing, such as a law firm or a CPA firm or something like that, a landscaper. But some industries are going to get the money first. And those industries might include, like newspapers is the classic example, except obviously newspapers are dying these days. And, they were once good, but good riddance to them now because they're just excuses for like creepy people to drive around in vans, terrorizing children, acting like they're throwing newspapers at people's houses. It's no good. It's no good. But anyway, then you've got the magazines, and then you've got like online applications now with a subscription model, in which case you get paid before you provide the work. So on an accrual-based method, you shouldn't be recording the revenue even though you got the cash before you did the work. If you're in some kind of entertainment field like concerts, you're going to get paid before you do the concert. If you get paid and then don't do the concert, then you have to get the money back, or else you're a scammer, man. You're a scammer. So, and then if you're in a rental business, you might get the last month's rent first or something like that, or something similar to a security deposit, in which case it's not revenue, but it should be some type of liability. Now, in a book problem, what happens is when we record the unearned revenue, let's say we're in that old newspaper situation and these crazy people are still buying the newspaper, and so that we can throw it at their house and have that creepy dude. Used to be a kid on a bike, but now you got some creepy old dude in a van driving around throwing papers at people's house and handing out candy to children. It's no good. But anyway, let's say that they ordered that for whatever, for nostalgia's sake, for it's a tradition. It's a tradition. So they still order the newspaper. And so then when they get the money, when we get the money, if we were selling the newspaper, we would have cash going up, but the other side should then go into unearned revenue because we haven't yet hit their window with the newspaper, thereby earning the money that we get. So that means that we can't record it as revenue. It should be in a liability. And then periodically at the end of the year, what we're going to do is determine how much of the unearned revenue has been earned, and then take it out of unearned because we've broken a few windows at that point, earning our revenue, and put it over here into the revenue side. See, it's newspaper. It's mostly peaceful newspaper delivery. But there's a problem with that, though, and that is in a book problem, they can kind of tell you how much of the unearned revenue has been earned. But in practice, how are we going to determine that? We're going to need a subledger, which is breaking out the information by customer, telling us how much of the unearned revenue has been earned. But unearned revenue is a liability that deals with customers. The problem is that customers are usually dealt with the accounts receivable account having a subledger. So this is an issue we discussed when doing the data input and thinking about this unearned revenue situation when we did the data input, noting there's a few different ways that you can think about doing the data input, and some software has different kind of components to do the data input to try to make this concept a little bit more easy. But the idea from a bookkeeping side is I would like to track everything in a subledger, like one subledger if possible, that deals with the customer, so I can track all of the payments that have been received, but that have not been tied, say, to an invoice, for example. So, for example, in that situation, you might say record a received payment. If I was to look at the subledger over here for accounts receivable, because this is the one that deals with the customers, I would think what I would like to have is an amount that's going to be a negative amount or credit balance to their account when we receive the payment, which I can later create possibly invoices for, applying the payment out and matching them to the invoices, which are gonna record the revenue when they're basically earned. Something like that would be happening. Or in our situation, we were selling guitars. In that case, we had people call in and want a special order of a guitar, but they wanted this ugly color that we didn't have. So we're like, dude, we'll order that for you, but we don't want to get stuck with that in our shop because we don't want it. What are we going to do with it? It's ugly. It's not. But we didn't tell them that. But we're like, you have to give us a down payment in order for us to order that guitar for you, so we make sure that we're not stuck with it. So you're committed, and then we can invoice you. Well, in that case, we're going to get a payment before we do the invoice. So I'd like to do that on the subledger for accounts receivable from a bookkeeping standpoint, because then everything has one subledger for all customers. However, that's not exactly correct from a financial reporting purpose, because it should be on the subledger possibly for unearned revenue. We might need a subledger for unearned revenue. This should be unearned revenue. I won't change it right now, but that's going to lead to more complications, because if it's in unearned revenue, what if we have a subledger for unearned revenue? We're going to have to take it out of that subledger and move it over to accounts receivable when the payments have been received. Some software, like a Xero software, kind of does that for us. It has an automatic process that kind of does that. But even still, it's still more complicated, because that process is doing multiple steps behind the scene to try to do the two things at the same time, meaning record properly unearned revenue as a liability and allow the bookkeeper to easily track that information on the subledger reports. So from a practical standpoint, if you don't have that, some other software like a QuickBooks, for example, might tend towards that later, or more advanced versions might have some of that in there, but it's actually easier sometimes to not do that and just say, I'm going to record a negative receivable. If I record a negative receivable, it's not correct when I record it, but once I do the invoice, it will be easy for me to match out in the subledger reports, and it'll look the cleanest that way. So oftentimes you might set things up that way as long as everybody's on the same page, meaning we on the bookkeeping side are going to say, I'm going to achieve the objective of making things as easy to input as possible, have only one subledger instead of two subledgers, make my subledger so that I can communicate with my customers as easy as possible, and be able to connect the invoice and payment forms if I was using software as easy as possible. And then the accounting department, when I do reporting at the end of the year, then can do the adjusting entry to adjust the accounts receivable to the proper amount and to record the proper amount of liability for those amounts that are still negative receivables per customer. So from a practical standpoint, that's often what ends up happening. We still use the adjusting entry as like a period end adjustment, but in this case, it's not a classical adjusting entry in that, notice in this case, we don't have a balance sheet and income statement account that's affected. We have two balance sheet accounts. We're gonna adjust the accounts receivable, and the other side's gonna be adjusting the liability. Whereas in the book problem, we imagined that we just keep on collecting revenue, having accounts receivable go up, 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 never recording revenue, and then we determine how much of that revenue has been received. So again, that makes sense from a book problem, but logistically you can see that's kind of a problem in practice, because again, the unearned revenue is you're going to have to determine all of the customers that are tracking the unearned revenue to determine how much of that revenue has been incurred in order to do the adjusting entry that way. Okay, so that's why in practice, you end up with this situation that we're talking about here for unearned revenue, where we have this negative receivable situation. All right, hopefully that makes some sense. All right, so let's go back to the adjusting process, and I'm going to say this is going to be for 228. So we have an ADJ unearned revenue. So now what I'm going to do then at the end of the year, particularly if I know that I'm in an industry, if I know this guitar shop has this situation where people order guitars and they put down a deposit to hold on to the guitar, and I know that the guitar shop puts that in place as a negative receivable, which is often the case if there's deposits. So any type of industry that has deposits, that's what you want to be asking. If they were a rental company and they have the last month's rent, or if they are a newspaper or subscription company, how are they recording their revenue that they're getting in advance? Now, again, oftentimes they're going to have a system where they enter, say, a payment form into QuickBooks, which is usually the form that you enter after the invoice, but they might be entering that before the invoice and then matching the payment form to the invoice, right? And they enter the invoice afterwards once the revenue is earned. So if that were the case, and we say, okay, maybe that's the case, how would I know that? I'm going to go into month 2 because this is where the subledger has more detail. And I'd have to go into their subledger and see, this is the accounts receivable subledger. It's over on cell AX over here. And if I scroll down, I can see that some of the receivables have a negative balance. This one in particular for customer Eric Music, I think it is. Is that the one? Yeah, has a negative amount in it. Notice that the accounts receivable total is not negative. This accounts receivable total should match what is on the accounts receivable general ledger, and it's positive. But I have to look through the subledger, looking at the accounts receivable per customer, and see if there's a negative balance, which I can see here. Now, in some cases, it might be possible that the customer actually has a positive balance, meaning that they still owe us money, but that there's a deposit in it that hasn't been applied out. So in this case, we have, for example, this one up here, this $250 for Smith guitars is a result of they owed us money for one sale, but then they had another amount here that they deposited that wasn't applied to the invoice, but rather was a deposit for another guitar that they're going to be purchasing in the future. So we would have to look to be detailed. We'd have to look through the accounts receivable and look for payments per customer which haven't been applied to an invoice, which should be fairly easy to do and would normally result in customers having negative balances in their accounts receivable accounts. And then we could just say, okay, I'm going to adjust the accounts receivable for those negative balances because they shouldn't really be negative balances, because a negative balance in accounts receivable basically means that we owe them, which we do. We don't owe them money. We owe them hopefully the guitar that in this case that we promised them. So I'm just going to increase the accounts receivable by the amount of these amounts and post the other side to the unearned revenue, properly reporting it as a liability instead of an asset. So that's going to be the adjusting entry. Again, it's a little bit different than a book problem. So the two amounts are the 450 that it adds up to. So that's going to be our idea. Now notice that if you're doing these adjusting entries only for tax purposes and they're a small business like a sole proprietor, you might not need to do this at all because the Schedule C doesn't have the balance sheet on it. So the income statement is properly reported the way we are doing this right here. And so it shouldn't be a problem for the income statement. It's only if you have to adjust the balance sheet, which you would need to do if they're a larger business, which would have to report a balance sheet for taxes or possibly for external reporting if they needed to make financial statements for, say, the bank or for their own internal needs or for investors, for the bank if they needed a loan or for investors, right? All right, so then we're going to say, all right, so what's this going to do? The accounts receivable needs to go up by the 450 for those negative balances for the customers. And the other side is going to go to unearned revenue. It's going to go up. Unearned revenue is going to go up. Boom, boom. I'll put zeros across the board. And then, now when I'm doing this in my Excel worksheet, it's nice and easy to do. I could just do a journal entry like this. But if I was to enter this into the QuickBooks system to make their financial statements correct as of the end of the period, I'm going to run into a problem for most software like a QuickBooks or a Xero, which will not allow me, once again, to post to the accounts receivable unless I do something to the subledger, because it will throw off the subledger to the general ledger. My subledger will no longer match the general ledger if they let me do that. Now, in this case, I wish they would let me do that anyways, because what I want to do is not touch the subledger because that's going to mess up the bookkeeper, but rather enter the adjusting entry here and then do a reversing entry as of the first day of the next month so that it never messes up the subledger, which will confuse communication with the actual customers. So, but I can't do that. So I have some options if I'm going to enter this into like a QuickBooks system. What am I going to do? Well, I could make another account called accounts receivable, but not make it a accounts receivable type of account. And therefore the software will not give it the same kind of subledger and force us to add a customer for it. Although that's kind of ugly in the reports because now you're going to have accounts receivable grouped under accounts receivable and then another one that's a other current asset, which is kind of ugly. Or we could say, we could actually post to the client's account here. So the two that we have, I think it was Smith Guitars and I forgot which two, the one, whatever customer it was, I can enter it into their subledger. But that's going to be kind of ugly because then when you communicate with Smith Guitars, it's going to show this journal entry. And journal entries aren't normally what you see in there. It's usually going to be invoices and payments. So that's going to mess up the bookkeeper a little bit as well. Although hopefully we could just match out the adjusting entry to the reversing entry so we can see that it would match out and it wouldn't mess him up too much. But another option is maybe we just make up another customer for the adjusting entries just so that we can record it. And I'm going to call that customer ZZZ adjusting client so that it hopefully shows at the bottom of the customer list and is only there for our adjusting entry, so it's kind of out of the way. So this is kind of the middle ground of creating another account that's going to be in the other current assets or putting it in the detail and messing up the details. So I just make this other customer. So that's what I'm going to do. I'm going to say this is going to be equal to the 450, increase in the 450, matching what we did to the receivables. I will copy down the balance. So let's copy down the balance. That brings the accounts receivable subledger balance up to 23,151. Does that tie out to what we're going to have in the general ledger? Let's check it out. Accounts receivable is going to be the prior balance plus the current activity is going to be the 23,151. Is that what I said it was? Yes, that's correct. All right, let's copy this down. We'll copy down the formula. So notice this is why this is not a classic adjusting entry the way we did it here. Why? Because it doesn't have an income, there's no timing component to it. If it was a book problem, there would be a timing component because the idea would be that we're just going to keep on recording the liabilities upwards and then figure out how much has been earned, reducing the liability, recording the revenue side. So that would be a classic adjusting entry. The way we're doing it, and with software, this is often the way even a subscription model might be set up, right? Because if you have the subscription model, you might be able to set everything up from the start to kind of automate the process, and therefore you don't have to manually count how much has been earned, right? Because you could say, if you got a yearly subscription, I'm going to record the payment for the yearly subscription, which will be a negative receivable, and then I'm going to record a series of invoices possibly that will be timing invoices, which will then automatically post monthly, right? So I can actually do a reminder invoice so that on a monthly basis, I can automate the process of it recording an invoice which will match out to the prepayment. So that's why we don't normally have that book problem scenario where we're manually going in there and trying to figure out how much has been earned. Although in some cases you might still see that, but you might more commonly see something like this situation where you have to see how are they recording the liability? Did they record it as a negative asset or a liability? How does the software account for this payment that was received before we did the work? All right, so I'm going to put an underline under this one. Let's put an underline under here. And underline, boom. And then we'll copy down the balance. Copy that. Let's drag this one down. We'll drag it down. Put an underline under these. Underline. And then we'll say this equals the SUM of prior balance, current activity. Copy that. Roger. Holding down shift, right arrow, all the way to the right. Boom, boom, boom. And then right click and paste it. Just the formulas. Okay, and then we'll copy down this and copy down these for formatting's sake. Bam. And so there we have it. So now the accounts receivable is at the 23,151 and the unearned revenue is at the 450. And so that is correctly breaking out the liability for reporting's sake. Now notice that if I didn't reverse that, it would look kind of ugly if I enter this into the QuickBooks system, because because on the QuickBooks side, they don't use the unearned revenue. So this is going to look ugly. So what we'll typically do is just reverse it, do a reversing entry as of the first day of the next period to get the financial statements tied out correctly, but then just reverse it on the next day so we go back to the normal formatting that works well internally for the bookkeeping's perspective. This being something that, again, a lot of people in public accounting don't understand, especially if they're in larger financial accounting departments, work like if you worked at like an auditing department and for public accounting and whatnot for reporting purposes, and then they work for smaller businesses, sometimes aren't able to communicate between the accounting department in terms of what their needs are for internal reporting, because all of their focus is, of course, on this really complex process of getting the financial statements recorded in accordance to very strict accounting rules of generally accepted accounting principles. And they're not really thinking about, okay, once I do that, how can I make sure I don't mess up the accounting department when I enter these adjusting entries? But if you're in small to mid-sized businesses and doing taxes in particular, that becomes something that's going to be, of course, very important, because you want to find that balance between making sure that the financial statements are reported correctly, at least for taxes, but not messing up the accounting department when you enter it into the system. How are you going to enter that back into the bookkeeping system without messing them up? Reversing entries are something that we can keep in mind to help us with that process, which we'll possibly do in future presentations.